Hi, thanks so much for joining in. You're watching NDTV Profit and I'm Alex Matthew. I'm at SBI Mutual Fund today because they've got an interesting fund that they're launching. It's called a Quant fund, but there's more to it than just that. In fact, to talk about what it entails, I'm joined by Ruchit Mehta, who's the head of research at SBI Mutual Fund. Ruchit, thanks so much for
Hi, thank you, Alex.
Let's talk about what this is, because in the presentation that you made just a short while back, you said that this is a model that you've been using from 2015 and finally it's getting into a product in and of itself. Yeah. How does it work?
So this is something that as a team we started researching and investigating about, that how do we create a framework that kind of helps us understand what is actually happening in the market in terms of what are the factors that are driving the returns of the market today. And from there it kind of evolved into a framework for us to tell us that, look, these are the factors that may drive returns going forward, be it growth, quality, value, or momentum. Right? So these are the four broad factors that we are focusing upon. And from there it's evolved into a framework by which we can say, look, we can launch a product on it. And therefore we are very excited that now we are at a stage where enough work has been done, enough real market testing has happened, that we can confidently launch a actual live portfolio on the basis of this.
Okay, so let's get into the brass tacks of it, because you're talking about four factors.
Yep.
There'll be a combination of this at all points of time, and 200 is the universe that you invest from, right? So at any given point of time, what is the kind of size of the portfolio and how would that portfolio selection take place?
So great. So we are looking at investing in the top 200 companies. Right. What will happen is that every company will get a score on either of the four factors. Right. Then those factors are weighted based on what the framework is telling us is expected to outperform. Right. Then we get a composite score, and then on the basis of the composite score, we sort of construct the portfolio. The idea would be to here also factor in aspects such as liquidity. Okay. What is the active weight of the security, etc. So we would look at creating about a 30-40 stock portfolio out there. And over a period of time, on a monthly basis, we will keep reviewing the framework and keep adjusting the portfolio based on what the framework is telling us, what factors should be overweighted or underweighted that's there.
And so, therefore, given that this is going to be driven by these triggers, you would see a higher churn in that portfolio.
You should anticipate that there will be a higher degree of churn. In our back testing, this has had about roughly between 20-25% monthly churn. So unlike a normal active fund of ours where typically the holding period would be 3 to 4 years for the security, or let's say 25-30% turnover ratio, here the turnover ratios could be as high as 3 to 4 times. So, and therefore the focus on the BSE2 or the top 200 companies where therefore liquidity is much higher. We've been working with a higher AUM threshold to check for the fact that this should not be driven by the fact that there's a smaller AUM. So we have looked at the mid-size AUM as a concept to test for the performance of the framework itself.
And that's about 4,000 crores.
Yeah.
Okay, I want to zoom out a little bit. And since this model is something that you utilize in the construction of the rest of your portfolios, what are those triggers telling you right now? How have you seen the market move? Of course, you've seen that consolidation take place or the drop in prices in several pockets. Where are we at right now?
So what we do is that this framework gives us a kind of a lay of the land, right? What's happening and what's likely to happen. And that kind of feeds into our discussions internally with the fundamental team to sort of understand that, look, what is the sector analyst telling us to do? What are the portfolio managers' current portfolio construct and his stance? And that's the starting point for our debate that's there. Where it stands today, right, it is telling that last few years which have been very much focused on value as a strategy, where we've seen a lot of value-oriented funds have done a lot better, and where quality as a strategy underperformed, right? And we are at a stage where that flip has happened. So early part of this year, around April, the model said that you should be more overweight on quality and growth as factors against pure value and momentum as factors. And that's what happened in the market, right? In the last 3 years were fantastic for markets. A lot of small, mid, micro, SME stocks have seen a very significant return that's happened. A lot of themes have played out, and we're starting to see those corrections that are there. So going forward, I think you should see that these kind of corrections should continue till we find a level which is a lot more palatable in terms of valuations.
So am I interpreting that in the right way when I say that consolidation is expected to continue heading into the first quarter of next year?
Quite likely. I think markets should be volatile, given that there are a lot of question marks popping up, right? What direction is inflation headed? What will central banks do? The incoming US administration, do they have a change in their economic policies? If so, then what does that entail? So there are a lot of open-ended questions, and typically given that markets also have had a very strong rise, there is scope for continued consolidation to happen in the markets.
Fantastic. And leave me with the kind of thinking that you have on your hybrid strategy right now. Obviously, this is kind of an indication of how the fund house sees the market right now. So the ones in which you have the dynamic
asset allocation,
where are you positioned right now?
So the dynamic asset allocation strategies have been underweight on the equities. So over the last year or so, the underweight has increased. So where, for example, for our balance advantage fund, where we were at about 40% on equities, down to about 30 odd percent. So we are still underweight on equities per se. We've been more on fixed income, and in some of the multi-asset allocation strategies, we've been having a little bit more tilt towards some of the commodities such as gold or silver. So still underweight on equities and higher on fixed income at this point.
Fantastic. Thank you so much, Ruchit, for taking the time.
Thank you for having me.
Thanks so much for tuning in.